Foreign direct investment has been dropping around the world for the last few years, and there is no shortage of candidates to blame for that drop. However, is the drop in FDI really anyone's fault? As it turns out, no. Instead, what we're seeing is the direction of the global economy going where we don't want it to. Hello everyone, my name is Tyler. I'm a huge finance nerd and I am the head editor and owner of Wealth and Wisdom on LinkedIn, and today I'm going to be talking more about the FDI crisis. Now, I'm not sure where this will end up eventually, but I'm trying to test this out, so if you like this, be sure to continue to watch to the end because I will fully explain my opinions on the matter, and like and share this video. The question of is insert your favorite scapegoat responsible for this month's flavor of financial problem is always a fascinating one for me. However, like many of the problems that I have researched up to this point, a shift in politics is not as big of a cause as everyone thinks it is. In fact, if you watch to the end of this video, you'll understand that the shift towards nationalism and populism that we see today in our modern markets and our modern economies and modern governments is a symptom, not necessarily a cause of the problem. For those who haven't heard of it before, foreign direct investment does exactly what it says on the label. It's a composite of all the investments flowing out of one country and into another country and vice versa. It's a major tool in the economic development of the world, and especially for smaller, less developed economies, it's necessary to help them keep growing. I first learned about this over the past couple of years in my finance classes, but this last week in one of my lectures made my jaw hit the floor when one of my professors, a former banking professional, blamed the drop in investment on nationalism. This, paraphrasing, is pretty much what he said. Well, there's a lot of reasons why FDI has dropped. One major reason has been the shift back towards nationalism, with leaders like President Trump being reelected. Look, I'm not going to lie, nationalism and populism present an interesting set of challenges for global commerce. So far, every populist leader that I've seen elected in my lifetime has been fairly protectionist and insular, and that does change the game a fair bit. But we can't blame FDI on Trump or nationalism. Not even close, because there are much bigger drivers for the recent drop that aren't being talked about. But if it's not Trump and it's not politics, then why has FDI been dropping? Let's take a look at it really quick. Global FDI fell by 2% last year and is continuing on a downward trend, as we can see from the trend line on screen. In the past 2 years, as I've been doing deeper dives on economics, especially globally, I've noticed that there are two bigger causes for this that are never talked about. And let's start with one of the biggest ones and get right into it: economic uncertainty. The frank reality is, for most of the world, people are anxious and uncertain about the future of their local economy and the global economy as a whole. The US dollar index makes this abundantly clear. For people who don't know, and I know Eurodollar University teaches about this a lot, the US dollar is where investors run for safety. And as we can see from the graph here, it's risen up 6% from its last low and up 18% from 2022. Investors are trying to find a safe spot to hold their money overseas. And considering that the dollar index has risen and the trend line is turning up, that looks like exactly what's happening. Investors are just uncertain about the investments they had before, so they're pulling their money out and moving it to a place that they know is safe. So don't just take my word for it. It's easy to understand why. Over the past 2 years, we've seen more and more signs of economic anxiety aside from the US dollar index that I just showed. Here are just some examples that I've seen in my day-to-day just watching other analysts on YouTube. An analyst from The Print on YouTube said that global investors don't see India as investment friendly anymore because of their regulatory landscape. Tony from China Update, a financial and analytics channel that I absolutely love. If you haven't checked it out, he provides a great breakdown of all the economic information on China. Even he has said that investors are preferring to pull their profits outside of China, and that was last year. However, the biggest damning factor comes from Forbes. Courtney Finger, on one of Forbes' articles specifically on FDI, had this to say: The main reason for the declines, at least in internal project finance and mergers and acquisitions, were tighter financing conditions, investor uncertainty, financial market volatility, and increased regulatory scrutiny. So, to say that in plain terms, investors are nervous, markets are responding, and a big part of that is regulation is causing them to be concerned. There are other factors, but that is definitely part of it. And like I said before, aside from what Forbes and other places have said, Eurodollar University has talked about this a lot. One of the big ones that he keeps highlighting over and over again is the fact that the copper to gold ratio is shifting towards an anxious time rather than a time of growth. And we see this over and over and over again, as we will continue to see throughout this video. The US dollar index, the copper to gold ratio, failing new orders, which is another metric that we use to track recession and other economic factors, and many more are all showing the same thing. Investors are scared. Let's go back to actually the politics of it for one more piece of evidence to prove what I'm saying about economic uncertainty. For the 2024 US presidential election, which I know a lot of people were watching really closely and there's tons of people who've been worried about, throughout the night on election day, my wife and I heard the same thing over and over and over again from analysts. It didn't matter what a politician said. People voted based on who they trusted to fix the economy. The average consumer simply is not buying the narrative of anymore of a soft landing or a robust economy when they're paying more for eggs, bread, and gasoline than they have in a long time. The oversupply and rising inflation costs for the US and other countries around the globe are making consumers more pessimistic than ever. In fact, the 2024 World Economic Situation Report dropped their previous growth predictions from 2.7% to 2.4%. China has lowered their own GDP growth numbers, which was something that they stuck to for years. And JP Morgan predicts a 0.7% below trend pace for US expansion. In other words, they're expecting the economy to drop as well. As you can see, people just don't trust the narrative anymore. And when they don't trust the narrative, they start to pull their money out. However, there's an even bigger factor. Despite the fact that this economic uncertainty has done a lot to damage FDI and where money's flowing around the globe, there's an even bigger one that we're about to see. And that has to do more with the US and Europe than it does with FDI in and of itself. When you break down FDI by the global area where those investment funds are going to and coming from, there's a clear driver for the fall. And that is that Europe is becoming more financially insular. They are retracting their money home. Don't believe me? Take a look at these numbers for FDI data based on those global regions I talked about. And I wanted to use this as well to highlight a problem that we see often in what are called aggregate numbers like FDI and GDP. And that is that large deviations warp the actual reality of what's happening in the numbers. We saw this before when we've looked at the financial markets and specifically equity markets over the past couple of years, that the Magnificent Seven have a bigger effect on the major stock indices. FDI is no different here. The big players around the globe warp the numbers. And that's exactly what we're seeing here. Take a look at this graph. What jumps out to you? When I looked at the first thing, I noticed two things. First off, global FDI isn't falling across the board. In fact, Asia and developing markets are ramping up their foreign direct investment pretty heavily. Second, though, Europe has tanked. While North America has fallen as well, it's nowhere close to the drop that Europe saw from 2021 to this year. As for last year's numbers, Europe's FDI fell 4% from 2022 to 2023, and we'll be curious to see the numbers that come out this year, because my guess is it will be very similar. Because of the size of the United States and Europe's effects on FDI, we totally miss the increase in FDI by these smaller developing countries. Again, back to the Magnificent Seven. When you have a small number of large players, it's hard to see the actual effect of what's really happening in the markets themselves. I've considered doing a video talking about that more, so if you guys are interested in that kind of thing, please let me know in the comments and I'll be happy to make it for you. But back to FDI, why are we seeing this huge drop? Obviously, it's fairly clear from the numbers that Europe is a major cause in the downturn. But what is happening? EY released an article earlier this year that explains it better than I ever could. So reading it directly from their article, companies cited increased regulatory burden, volatile energy prices, and political instability as the top 3 risks impacting investment decisions. Between the Russia-Ukraine conflict, higher energy prices, and regulator issues, and a sluggish economy, Europe can't afford foreign direct investment. If it wasn't for growing FDI in Asia, in fact, and of other developing countries, the numbers would probably be worse. This goes back to a fundamental fact I've had to bring up with my friends over and over and over again, is the fact that in most cases, economies as a whole act very similar to corporations, where if their costs are too high, the net benefits they produce start to go down. And that's exactly what we're seeing here in Europe. Instead of this being driven by some political figure or some single issue, their costs are just too high. My guess is we're seeing something similar in the United States. I don't have the numbers to back that up, but my guess is anywhere where a country has experienced higher costs in things like energy, regulation, or they're experiencing a lot of geopolitical conflict, you're going to see these numbers drop. So let's wrap it back around just in closing today. And again, like I said, if you enjoyed this video, please like the video and share it with someone you might think will find this interesting. It would help me a lot to know that people actually want to hear topics like this. If you would like to see more of this content, please let me know in the usual factors. Liking, subscribing, and sharing with your friends helps a lot, not only for the algorithm, but also for myself to know that this is something people are interested in. I wanted to close off briefly back where we started. This is where populism and nationalism come back in the FDI narrative. I wanted to start with this quote from Nietzsche. Populism is the politics of anger. In my mind, the reason why so many places are switching to populist leaders and away from the typical leaders that we normally see elected or have up to this point is because consumers are exhausted and they're not buying the story anymore. Think about it. For the last 6 months or the last year, we've been told the same story over and over again here in the United States and in other places around the developed world where the economy is strong. We're seeing job growth, we're seeing GDP growth, and the numbers just aren't telling the truth in the way that people are perceiving it. I've posted on LinkedIn before my concerns with GDP as a method for tracking specifically recessions and other economic times of stress. But the biggest thing is it doesn't matter what the numbers are saying if the consumers are too anxious to spend. And that's what we're seeing here. We've highlighted that the economic and financial factors earlier are making people uncertain and anxious. One of the basic rules that I learned in finance and many other people know is that an investor will only take on new risk if they're being compensated for it. And countries and companies are no different. In other words, if you have a company or a full economy that is struggling and the actual drivers of that economy and company are uncertain, in this case, consumer dollars, you're going to see things like FDI retract and those investments start to be liquidated just because there is not a guarantee that they're going to get that return for the risk that they are putting up. So they will remove it. To wrap this all up nicely, FDI is falling because times are uncertain and people want a change. That's what we see with populism. Just like we saw in the 2024 presidential election, countries around the world are focused more on their own economic struggles because those struggles exist. The fall in FDI shows this. And frankly, blaming Trump, Modi, or whoever else has come into the public limelight ignores the true economic and financial problems that are actually happening in global markets. And as long as we focus on those problems, the real problems don't go away. If we really want to see a reversal in this trend in foreign direct investment, we need to fix the problems at the core instead of blaming the scapegoats. Thank you so much for taking the time to watch this video. If you like this, again, be sure to subscribe. I'm considering doing more content like this, so if you find this really interesting, let me know. Thank you. and have a wonderful rest of your week.